All right, so welcome back. We have been joined on set by none other than Ervin Perez, and he is the financial advisor at the Legacy Fund Limited, and we're going to be discussing the do's and don'ts of payday loans. Good morning, Ervin.
Yeah, good morning. Good morning.
Where do we begin from? Payday loans.
The first thing I would say, there's no good day for a payday loan. But that said, you know, there are principles of improving our financial health that if we fail to do, we will forever be in debt. But just for our audience, we'd want to walk through some of the main rules of the money lender's license under which payday loans are typically operated. Mm-hmm. And as we can see, that there's a huge business for payday loans in the country. The number of payday loan money lenders services that are proliferating is tremendous. The first thing though, the first important rule that an individual who is contemplating borrowing or utilizing a payday loan to meet Christmas expenses, which I would not advise, but it's going to happen, is that the maximum interest that a payday loan can charge annually is 48%. Mm-hmm. And so we'd want to ensure that when we're looking at the offer, the loan offer, that we're looking at what is the maximum interest rate that I may pay. And if we go to our second visual slide, the law also allow payday lenders to charge a late fee, which is on a monthly basis a maximum of 4%. This is in addition to your interest rate loan. So you're borrowing a payday loan, the maximum they can charge you is 48% or some percentage of that over the course of the year. Mm-hmm. Plus, if you're late in payments, they can charge you an additional 4% per month. So that's another annually 48%. And then another important rule, you know, when you went to a bank or a credit union, they would say that there are some late fees, not fees, sorry, there are application fees and administrative fees for processing the loan, and we're going to charge you. The money lending regulations allow payday lenders to charge a maximum fee for fees of about 16% for every 30 days. So when you equate that for the year, that's 192% annually in fees by law, which they can charge. And that could be fee for, okay, this is an application fee. So you're borrowing 100, we're going to charge you a 16% application fee because we're allowed to do that, right? But that fee can be up to 192% annually. So that's why I'm saying there's no good day for a payday loan.
When I look at this equation and how this all maps out, one word that comes to mind readily is like usurious, like the
absolutely, absolutely.
The whole nature of, you know, borrowing money, I guess in advance of your salary being processed at work or what have you, and having to pay back an exorbitant amount over time for it.
And that's a lot of that is, you know, I'm a firm believer in financial freedom, so individual having the right to make their own financial decisions. And therefore, while we may be concerned about the usurious nature of the fees and the interest charge, if we live in a economy or in a country where we believe that at the end of the day, not in the short run, but at the end of the day, people having more freedom to choose what they do with their money and how they spend their money and how they borrow, then we have to live with these kind of numbers. Because if you look at the most important thing, if you factor in the fee charge that can be charged, so it's 192%, and you factor in the interest rate that can be charged per year at 48%, then by law, and there's a caveat to this, but by law, a money lender or payday loan can charge you 240% annually on what you borrowed. That's 2.4 times what you borrowed. You can pay back just in interest and fees alone.
But aren't these fixed within a specific time?
Yes, it's annually. That's the maximum that they can charge you annually.
But they don't know.
So they will give you a 30-day loan.
Yeah, it's
a 30-day loan.
Let me put it, you know, Usually when people go to these places, it's because they feel as if though they're in a deep hole.
Yes.
Right? Can you ever dig yourself out?
Not with these types of loans. And that's why I'm saying there's no good day for a payday loan. But they feel that they're in a deep hole. They feel this is the only mechanism for a quick fix. The water bill is going to, you have an electricity bill that you cannot pay. You just don't have enough money. The cable is going to be cut out. Your gas has just blown, and you're looking for cooking for Sunday. And Friday, it's Friday. You're not going to get paid until the following Friday. Let me get a payday loan to tie me over. And the payday loan is 15 days or 30 days. So what is going to happen is that the interest rate charge will be a percentage of what will be annually. So if you think of the 30-day loans and you can pay $240, then the loan interest rate would say be about 10%. So you say, oh, it's a 10% loan for
So
30
let's
days.
put it in
So it
real
seems
numbers.
small, right?
Let's put it in real numbers, though. Let's say
You borrow
just
$500.
let's say 100, just to make it
100.
easy.
Okay.
Right? So I go on and borrow $100 and maybe 10 days
For
or,
10
or
days.
thereabout. What would be my repayment?
So it depends on the particular payday lender, but the maximum he can charge you annually is say $240. So if you do the maths and let's use a rough number of 50 weeks in a year, right? And you can charge $240, so it's about 4%, 5%. So they may say in 10 days you pay 5% on that. So for you it seems small, right? I borrow $100 and I may pay $105 or $110. It's small amount. It's not anything large, and that's the kind of illusion about payday loans, because typically people are borrowing in small quantums and they're paying back small amount of dollars. So I borrow $100, I pay you $20 in 10 days. But $20 in 10 days, if you would annualize that over what that means in terms of the interest rate, you're never really going to get yourself out of that hole. And typically what happens is that because of whatever put you in that scenario, usually it's bad financial habits. What happens on your payday, you realize you have a lot of other bills and you cannot pay back the full amount of the payday loan. And the payday lender says, no worries, don't worry, just pay the fee and roll it over another 10 days and another 10 days, and your habits haven't changed. Nothing has changed. You see you have a lot of other bills. Roll it over again, and you might even not even be able to pay the full interest. And I say, don't worry, we'll add that interest back to your principal, and now you'll pay on that, that new loan that we're going to give you, which is maybe the 100 that you borrowed plus 5 that you couldn't pay. So now it's 105, and you're going to get 10% or 5% on that for the next 10 days. And what we've seen with payday loans, not only here in Belize but all over, the debt level spirals to the point that the individual is just barely meeting the interest payment, and the principal is never going down. But the interest payments that are being collected by the payday lender is so large that they don't have to worry about recovering their principal. By the time a month has gone by, they've recovered the principal sometimes many times over. And so there's a if we go back one slide, I think though, if we can go back one visual slide, there is a okay. So go forward, please. My bad. So to do an actual case, we did a loan of $1,000. So you borrowed $1,000. Let's say it's payday. You're gonna borrow early. You figure you'll pay this back at the end of the month, and the annual interest that can be charged is $2,400. So let's say you would have borrowed this for 12 months. You would have paid back the $1,000 plus the $2,400. And so if you look at that slide, once you sign off on that loan, you borrowed $1,000, but now you owe $3,000. If you go to the other slide, you owe $3,400. You see how that just multiplies?
That's just over a month?
Well, this would be paid for a year.
Okay.
Yeah. So you would be paying $283 a month, right? When the amount that you're paying on the principal is just $83 a month. So that whole $200 is just interest and fees. You're paying more in interest and in fees than you're paying. And if you think within 5 months, you've paid back your $1,000, which is primarily only interest, right? You've paid back your $1,000 and you still owe principal and interest. Here's an important rule though. And we say in markets, the important thing is that sleep with your own eye. You, the borrower, need to really understand what you're doing, and you need to understand the rules. So although I said all of that before, William, the rule says, notwithstanding everything that we've said before, the maximum that a payday lender or a money lender can get from you is 100% of your principal. So all that calculation that we did, that you ended up with 2,400, the law still goes back and says, well, no. The
You
maximum
can't get 3, 4.
You can't get 3 to 4.
You only could get 2,000.
Then you only could get 1,000 on that 1,000. So when you're borrowing, you need to look at all the costs, because I've seen, we've had a couple of clients show us their little loan statement, and I've seen a loan statement where an individual have borrowed 1,000 and they're just the application fee is like 1,500, and you're like, wow. And the person said, well, that's the application fee. The interest rate is here. Maybe the interest rate is legitimately $48 or 48%. But it's the effective rate that they're talking about here. So the rule states that at the maximum, the total interest that you can pay is 100%. So let's go back to your $100. So if you borrowed $100, you should pay back no more than $200 when you satisfy that loan. No more than 200, whether they call it fees, whether they call it interest, they call it a signing boat, whatever it is, you should only, if you borrow $100 for a payday loan, you should not pay back more than $100 plus your principal, so
But
$200.
what accounts for the gouging of people, and why is it tolerated under the law if there's a maximum?
So there's two things, and you've mentioned it so often, you mentioned it at the very beginning. Most people that go for a payday loan feel that they are in an absolute hole, bind, and there's no avenues for them to get this money. A payday lender will also tell you it's very risky because I've taken no collateral. I'm just assuming that when payday, this person is going to pay me. Sometimes they ask for a salary assignment or a deduction. Sometimes illegally they've taken people's debit cards. Right? That was something that we had noticed when we were in the bank, that people were surrendering their actual ATM cards to the payday lenders, such that at payday, they would give them their PIN. These individuals would go to the ATM and they would have like hundreds of cards, and they're just pushing them into the machine and taking out the money out of the borrower's account. And then, that was illegal. Obviously, it was illegal to give your card. But individuals being in that circumstance, not having other options are there, and then there's so much proliferation of payday lenders. They're tangentially supervised by the central bank, so the regulations have that the central bank should provide oversight. However, there's no structured at this time how do you regulate payday lenders, and then the license are provided by the Ministry of Finance. So typically, a regulator provides both the licensing and the supervision. And they would then ensure that the individuals meet fit and proper criteria, that certain things are in place so that they can readily audit what you're doing. At this point, that's not available, William. And so therefore, you have the gouging of the individuals. You have individuals who are, we call them unbanked. A lot of the borrowers are unbanked. So you have a lot of street vendors, people that are self-employed, yard men, etc., who, even going into a bank or a credit union for them is they don't feel comfortable. Yeah. They can go into a payday lender without any much documents and get one of these loans just on, signing off on some agreements that we see with individuals that do yard work, for example. They may get their clients that they do yard work for, especially if it's long established, to say that they'll pay the funds, and that is sufficient. So a payday lender will say, I'm taking on risky clients, right? I have no kind of tangible collateral. The administrative cost of managing all of these small loans is large, so we need to recover our costs. So we have to charge what we charge. And when an individual does not pay, there's very little I can recover, so I have to recover it from everybody. So those would be arguments why a payday lender, if we're putting ourselves in the provider of the service, would say, we have to charge them so much, right? We're not being usury, we're looking at all the risk and all the costs of providing the service, and we're actually providing a valuable service because our business is growing and people are using the service.
But here's the thing. It is so very ingrained in our culture, so that when you look at what you're saying, and what you're saying makes perfect sense. And in a sense, it is sort of discouraging anyone paying attention from getting a payday loan. But then you look at the reality. A lot of us go to these places and we borrow money. Perhaps some of us hang our hats a bit higher than where we can reach. So we end up being indebted to these establishments. How do you break that? Because that's not going, it doesn't seem that it's going anywhere anytime soon.
Yeah. So there's always a need for credit. We say credit runs markets, right? You know, you never usually have all the money that you have. If you want to buy a home, you're going to have to borrow. So there's a need for a credit market. What obviously is happening here, and we would really love to encourage, and I'm not promoting the credit union specifically, but I think every Belizean worker, whether self-employed or working for somebody, should have a credit union account, should become a credit union member. Because if you just think about the simple mathematics, paying 240%, or let's say the maximum is 100% by law, but I know that's not being enforced. So it's more like 240%, and I've seen 400 and something percent on some of the documents when you do the calculation, which is completely illegal, but there's not an enforcement mechanism, so it's being done, or it's practiced. And it is quite formal, because on the form that I've seen, you know, they have the interest rate, and when you calculate the interest rate, it's 48%, it's a maximum. But when you calculate the application fee and everything, then it hits the 400%. So it's not being enforced. This would be a standard practice. So let's say if it was enforced and you were paying 100%, right? The average credit union typically would charge you 1% on the reducing balance. 1% on the reducing balance at the maximum is 12%. And then if you talk about at the end of the year, at the AGM, the credit union gives you back a dividend or a rebate. You might end up paying 7-8%, even less. So it behooves you to move your short term and those small loan borrowing to your credit union. Why individuals haven't done it? Some of the things that have come up is accessibility, right? Accessibility is a huge thing. Meaning you go into a credit union, the line is crazy long. You have to fill out a lot of forms sometimes. You cannot borrow the amount that you need. And so the payday lender is accessible, it's fast, it's quick. Show a social security card, bop your pay slip, and you're gone.
As the slogan says, money in minutes.
Money in minutes, and that's a challenge. So what we were challenged by, I would say, is that our credit unions, our other institutions, and I say more the credit unions, bankers will take a lot more care in lending. And for a lot of banks, these $100, $300 loans don't make any kind of financial sense, right? But for a credit union that is focused on its members, this was a role for the credit unions to play, to provide alternative financing for those kind of short-term needs. You have electricity is a little bit higher than expected, your gas blowout, you need a short-term finance, 10 days, 15 days at the low. And the credit unions could provide it even at a higher rate than the traditional student loan or health loan or whatever. They could, because it's smaller, and they might say, you know, it's a lot more administrative as well. But I think that's where the vehicle lies. Right now, the vehicle is not there, and so the payday loan industry is going to continue to grow.
Let me ask something, because as Isani rightly said, we see a proliferation of these types of businesses and people who are taking it. What are your recourse, or what is your recourse if you find yourself in a situation like this, where you've given your pound of flesh and then some? And you're saying that, you know, legally, some may be doing far more than the law allows. Most people won't think of going to a lawyer because that's more money, etc. But how do you nip it? How do you actually escape it?
The one way is what we call a refinance. So that's the recommendation. If you're going to be paying 240% interest or 100% interest, you would hope that you would be able to access a credit union and just borrow and pay off your payday loan, right? So maybe accessibility was the challenge, so you had to get the payday loan. But now, whatever was the emergency is now abated. Now is the time to think, I'm not going to go keep paying this month after month after month. I'm going to go borrow cheaper and pay off everything and close that episode. That's what you really have to do. That's probably the only option in terms of the cost benefit, because if you think, like you said, the legal option, unless it's a huge loan that you got through the money lenders and it's worth the while to get a legal counsel is going to cost you a lot more than just simply thinking about doing it another finance way. If you have family members who are willing to trust you and you're saying, you know what, I'm paying the payday loan 240%, or I'm paying them 10% a month, you know what, let me borrow from you and I'm willing to pay you 7-8%, whatever, or 10% a year and pay off this payday loan. So the important thing is to try to pay off the loan at a lower interest rate.
I'm looking at three things here, Ervin. You have pawn shops.
Yeah.
That I believe operate on a
under the
similar
money
premise.
lenders,
Yeah. You have
license.
pawn shops. You have the payday loan businesses. You have the loan sharks.
Yeah.
Right.
The loan sharks, are you considering loan sharks the one that are illegal, operating in the informal market?
Pretty much, yes.
Okay.
Because
Because
people
the
could
money
access
lenders would
money.
not want to call themselves loan sharks.
I know, but people, I'm just identifying these three
sources,
yeah,
yeah.
as avenues where monies can be borrowed from.
Yeah.
There is no mechanism in law that prohibits. Okay, I think there was a case about a year or so
Yeah,
ago.
earlier this year it came out, the judgment.
Yes.
With authors. I think 7 authors was on that case.
Yeah, where, for instance, if you surrender property
Yeah.
to the pawn shop owner or what have you, and then you default on the payment on that money that you borrowed, that they cannot keep your property and sell it and then keep the total proceeds of it, right?
Yeah.
They would have to return to you the balance of what they've taken that you've owed them.
Yes, exactly
correct?
right. Equity.
Equity, good. But there is no such trigger, for want of a better word, in the whole payday loans process, correct?
Yes.
That only applies for as a precedent in the pawn shop business.
And the reason why I think what William we had alluded to is the size of the payday loans and the clientele, right? So a lot of time the clientele, a large amount of the clientele might not be, and I'm not saying professionals. I've seen people going to the payday loans, but a lot of the clientele might not be literate, might not fully understand what they're signing on, and the amount that they're borrowing is so small that they don't perceive I need to put up something. The collateral a lot of times for the payday lender, like I said, was the debit card. So they take your debit card, which is illegal, but individuals in this circumstance feel they don't have a choice, so they surrender their debit cards. And I remember, like I said, when we were at Scotia, we would see individuals going in there, and they would have like 50 cards, and because we're monitoring them on the camera, and card after card is going in, and so we know this person is that's not his cards. He is a money lender, a loan shark, or and we need to prevent that person from being able to have the individual cards. But again, individuals have the freedom, they want to borrow. The terms of the borrowing is surrender your debit card, and I will know when you get paid, and I'm going to take out the first amount of funds. And the challenge, like I said, is that we just really need to expand the services that, for example, we can offer those individuals, because the need is there. The fact that you're seeing the proliferation, the need is there. Now, the other thing that we have to consider is a lot of the more established businesses have now created money lenders license. So Courts is the financing wing, the Ready Finance is now a money lender. And they will tell you, money for quick money, do you need money for a party or whatever, and you go finance, and it's an established entity, so people feel, well, that's an established entity, everything is nice and looks nice, I'm going to go and borrow, not really realizing the high interest. And this is another important reason why the actual interest rate is very expensive. The money lenders law allows money lenders to charge what you call simple interest rate. Now, what is a simple interest? It simply means that, and we put up the little formula, you did this in primary school, principal times interest times tax, and the other slide has an example. So if you have 10,000, and I did it over 3 years, but you could do it over 3 months. At 5% at 3, this is just the interest rate. You're going to pay 1,500. Why is it considered simple interest? It's considered simple interest because even though you're paying the principal down, you're still paying as if the principal has not been touched. Yeah. So over a month, let's say it's a 3-month loan, and every month you're paying down on your principal, but you're paying the same interest as if you borrowed that. So let's say look at the $100, William. You got $100, and they say it's 10%. right, for 3 months, right? So if you do the maths, that would be like, say, $30 you'd pay. Although you're paying some of the $100 every month, maybe $25, you're going to be paying a large interest as if the $100 was not paid for over the entire course of the year. I mean, out of the 3 months. So that simple interest charge means that the actual interest rate is even higher than the what you call the declared. So when we say 48% for the year, over 3 years, the effective rate is even more. Let's say about 55%, because you're not going to have, like with the credit unions or with traditional bank, interest is charged on the reducing balance of the principal. With money-lender's loan and payday loan, it's not. You're going to pay that flat interest, and some of them will collect the interest up front. So you'll go to a payday loan and they say, okay, the interest is $200 and you're supposed to get $800, you'll get $600. We'll collect the interest up front already. That even drives up the interest rate. So all of these are practices and supervising them. There's so many of them, I don't think the regulator would have the resource to do it. So it's sleeping with our own eye. We have to educate ourselves about good financial practices. It may come to a point that we need to get a payday loan, but we wouldn't want to keep the payday loan on the books. We want to refinance as quickly at a cheaper rate, either with your family or with your credit union or even a bank. A bank might give you a personal loan at 9 or 10%, which is per year on the reducing balance, which is far less than a payday loan of 240% per year. So that's the way we kind of try to get out of the circumstance if we have not practiced the good financial habits going forward.
Now, you said something that is resonating with me, the whole idea that people find themselves in this situation because they've had bad financial habits.
Yeah.
Can you reverse those habits on your own, or what do you need to do? I mean, the type of business that you're in is something that is almost like counseling to a lot of people, right? It's financial counseling, so people still see it as if though I'm not necessarily comfortable with telling somebody my business.
Absolutely.
But you're digging yourself in a hole that seems unsurmountable in terms of climbing out. What's your advice to somebody?
So one of the things that we see, and again, this is something that's universal about human habits, is a lot of bad habits are hard to break.
Yeah.
One of the ways of dealing with habits, though, is to create better habits. And we've found that to create good saving habits. So the first part of good personal financial planning is to save for the rainy day. I mean, Miss Jane used to always say, you save for the rainy day because it will happen. You go outside, you drive out, fender bender, all over Saturday, cars were all over the place. It was crazy, right? So even though you're doing well, and we've found out that it's hard for you to personally save, meaning that I might tell you, William, take 10% or whatever you earn. Now let's just be simple and say, take $100 a month every payday and put it aside. You know, when that money is in your hands, it finds use, right? I think I need a new shoes, I want to buy this Chinese chicken that I now get before. The rule of thumb, really and truly, is to take away discretion. You have to take away your ability to choose when it comes to savings. So we advocate all the time that you have standard deductions, that you take away your ability to not save by forcing yourself to save. So a lot of the employers that have talked with us are putting in place systems where, as an employee, you can ask your employer to withhold and put amount of money away in savings. That's what you have to do. You literally have to do it. And also you want to put away that money in a place that is not accessible. So you don't want to put it away in a bank and then get an ATM card because you're going to spend the weekend to take it out. It defeats the purpose. So you just want to put away the money, and we say, forget about it. If you're making $1,000 and you're saving $100 a month, then you have to consider that you have to live on $900 a month. That $100 doesn't exist except for an emergency, and you have to only, and it has been shown over and over, it will happen only if you tie your hand. And we've told clients, I mean, when you borrow, a lot of times from banks and you're an employee, what do you ask to sign? A salary deduction. People do it all the time for a financial institution, so you have to do it for yourself. So that's the first rule of thumb. You have to do it for yourself. The other thing is that you have to have some kind of small insurance. You have to insure, and you have to try to get some insurance like medical, dental, health insurance, and life insurance, because you have to prepare for the things that will happen. The challenge, individuals will say, well, health insurance and those things are very expensive, right? A couple of things. When it comes to small business, Chamber, through Sagicor, I'm not promoting them, but offer small business an opportunity to get group insurance for their staff at the prices that you would have paid if you're a large company like a Boeing and Boeing. The second thing is that you want to ensure that if you are, I know, for example, Public Service Union has a health insurance that you can get if you're a union member. So whatever opportunities are out there, you have to put those things in place. So a lot of it, William, is to put things in place that bind your hand. And again, with that kind of insurance, make it deductible. Your employer will deduct it from your salary so you don't see the money, and you will start budgeting and living on what you have. And then there are certain things that we have to just decide that, this is not a need, this is a want, right? I want this, but I don't really need it. And the best thing that can bind your hand is just not having the cash. Because if you have the cash, that want becomes a need, and then you'll spend it. So a lot of the experience that have been shown over and over is binding your hands. Another thing, William, is at the end of this year, a lot of people get this 13 months or bonus pay, right? It's bonus pay. And then we tend to spend that bonus pay before it even happen, right? Another thing is to sign up with your employer earlier, that if you're going to get a raise or a bonus pay, instead of the entire 5% increment coming into your account, set aside 2.5%. So live on a 2.5% raise. So it's setting up a lot of automatic mechanisms to force ourselves to save. And then over time, what has been noticed, when people see those nice, wonderful savings in their account, there's what you call a wealth effect. You like to see the money there, sitting there, and you like to see it growing, so you don't want to touch it. So that's how you get to that point where hopefully your payday loans are things of the past.
All right. Well, I think we've come to the end of the segment. We want to thank you for sharing with us, and hopefully, not very many people find themselves in that dire strait that they have to embark knowing this information now.
Yeah, that's true.
But sometimes it's hard to, like you said, you can go to family, etc. But if you have your track record, it's not one of repayment.
You're not
it's
gonna,
hard, right?
Yeah, well, yeah.
So you have to think about those habits that you may have.
Yeah,
but we want to
absolutely.
thank you definitely for joining us this morning.
You're welcome.
How can people reach out to you?
Well, we have our office number is 280, sorry, I didn't bring that, 280-0400, and my personal cell for the company is 610-7386. And we do personal financial advisory services. It's a smaller part of the business. We prefer to do it with companies and work through the companies with the employers, because we feel that for a lot of people, the employer has to be part of the behavioral change. And for a lot of employers, they really want to see the change, because a worker that is stressed out about finance is not a very productive worker. And it's also a worker that is dangerous in terms of getting their hands in the till and doing different things that can create a problem for companies. So a lot of employers are learning that we really want to work, just like we want to work with our workers on their health, because a better, a physically healthier worker is a more productive person. Also, a financially healthier worker is a more productive employee. So I think that's where you'd want the employers to take a much bigger role in helping their employees have a good life.
Ervin, thank you very much for joining us this morning.
You're welcome.
We're going to go ahead and take a break, and when we come back, it'll be for a wrap. Don't go anywhere. Open your eyes, concludes after these messages.